Up front on India tonight, top of mind is the kind of action we've seen in the markets today. The Nifty has continued its advance and now we're seeing it advance for 3 sessions on the trot. It has stayed above 22,300. And within the broader markets, we've seen the small cap index hit that new record high as well. Among the sectoral stories, we are seeing the realty pack emerge as the top gainer. The FMCG pack also did quite well for itself, and Tata Consumer had a lot to do with it too, and we'll tell you about that in a bit. But also the auto pack was among the strongest gainers if you look at the sectoral picture. The pharma sector has come under pressure, followed by some of the metal counters and some of the energy stocks as well in trade today. But the big story has to be the volatility index. The India VIX has dropped as much as 20%. And the question is, why exactly did we see such a strong crack when you talk about the volatility index? Let's take stock of the move straight from the year 2010 to the kind of levels we are seeing now. Kunal Bothra, my colleague here at ET Now, is joining us to decode what's happening with the volatility index and what this crack really indicates. What do you make of this fall in the volatility index today, Kunal?
I think it's a very significant kind of a day where the India VIX has fallen below the 10 mark. But is it one of the only days where the India VIX has fallen by a margin of 15%, 20%? And so I think historically we go back and I've taken the data points specifically from 2010 onwards, because prior to 2010 there have been almost like 8 or 9 trading sessions or days where the India VIX has fallen by more than 30% and 35% also. So I've taken that as an exception and moved on from 2010 onwards. And there have been multiple times when the India VIX has fallen by a margin of 34%, 30%. 2010, for example, was one of the years, 2010-11, where the India VIX had fallen on a single day by 19% to 22%. These two are very important and critical dates because both of these are the years and the months and the days where the election data was announced, and when the market got into an end of an event mode, that's where the VIX tends to fall down. So VIX is particularly, generally it spikes up pre the event, and post the event it generally tends to mellow down significantly and then go into a corrective phase. But this time around in 2024, we've seen the India VIX already falling before the event is out of the play for the index. And more importantly, we go back to the historical connotations of whenever the India VIX has fallen by a margin of say 15% to 20%, what has actually happened to the index or the Nifty and the resultant trends going forward. So 2010, for example, when the India VIX had fallen very sharply, post that we saw a major bottom formation on the index. 2011 was also similar. If you go back to the charts on the Nifty, 2010 and 11 were the 2 days where the Nifty formed a major bottom. We started off a strong uptrend. 2014, post the elections, the Nifty started a very strong uptrend. The base shifted up higher for the Nifty. 2019 was also very similar. The index managed to move up higher. And 2024, I think we could probably be seeing a similar trend for itself. So, which means when we go back to the historical analysis and the trends for India VIX falling below the 10 mark, as well as falling below the falling to a double-digit tone, we've seen historically that results into the index moving on, going into a gradual, steady as well as a strong uptrend.
Right, Kunal, so a lot to do with elections just before and just after, but this time it seems different. Let's get further perspective from independent market expert Mahantesh Sabarad joining us on India Tonight. Great to have you with us, Mahantesh. This volatility index, it's also called the Fear Guage. Now, how do you read the sharp slide that we've seen in the VIX today? Is this a good sign or is it a bad sign for investors? Because to some, this is suggesting volatility in the near term. What's your reading?
I think the theoretical aspect about VIX and the interpretation of the VIX says that whenever the VIX falls, the overall fear factor in the market is lower. That means, and the risk levels are lower. Therefore, the market can head to higher directions herein forward. That's the theoretical interpretation. But very often, VIX is either preceded or post the VIX fall. There are certain events that take place which are primarily technical in nature. There could be a reconstitution of the Nifty, for example, that means the broader indices. There could be a reconstitution related to how the stocks are traded. And we have seen that there's been a major reform as far as the stock markets are concerned. We are moving towards a T+0 kind of index settlement that eliminates a lot of risk that is associated with the markets or intraday fluctuations that are associated with the markets. So I would say that there are technical events that suggest that the VIX has fallen substantially. Index composition, the way index gets traded, as well as events, upcoming events. You did talk about the elections. Yes, that's an important event to look forward to, and the market tries to gauge and feel what the outcome could be of the elections and has its own understanding of the elections.
Factors at play. One of them is elections, and this does suggest how relaxed the markets feel about the outcome of the general elections. Perhaps it could mean that the T+0 kind of settlement picture that we are headed towards, that also makes the markets more sanguine. How much has the Vodafone Idea FPO and the way it has been subscribed? What does that say about the liquidity situation in the markets now? And is that also reflecting in the way we've seen this slide in the VIX?
See, generally speaking, the capital raising activity in the markets has been quite strong. And when it comes to frontline stocks raising capital either by fresh issue or through a combination of scheme of arrangements or amalgamations, etc., suggests that stocks or companies are growing bigger and larger. Whenever such a thing happens, whenever stocks or companies become larger, the associated risks with the business sometimes taper off, and that also gets reflected in the way VIX behaves. We have had very large mergers recently, HDFC Bank being one of them. As a case in point, we had large stock issues in terms of market capitalization itself. LIC is an example of that. And now we have a distressed kind of company, a Vodafone Idea, successfully managing to raise capital through a follow-on public issue. All this tells you that while liquidity is strong, the market sometimes has its own equation that says the risks are lower because the companies are becoming better, stronger, and bigger.
Companies are becoming bigger and stronger, like you're suggesting, Mahantesh. How do you read into the progress of this earnings season? Is it reflecting in the way the markets are moving right now, the kind of earnings that have been reported? And how does that show on the VIX?
So, as far as earnings is concerned, I am a little bit skeptical because now it's the end of the year. There are a lot of adjustments that happen towards the end of the fiscal year. And we have seen that banks would like to relook at their numbers in terms of provisions that they have, and that's what we exactly saw with an HDFC Bank result where the provisioning was a bit higher. They made excess provisions actually then required, but then the norm is provisioning is higher. We are seeing that companies take up or clean up their balance sheets by either writing off some of their old assets or impairing their assets in a way such that they become better going forward. And you also have a situation here in that the monsoon prediction forecast is suggest that it could be a normal monsoon, which could mean that we would have better earnings ahead. But Q4 will have a lot of surprises in terms of the companies cleaning up their balance sheets and making excess provisions. Typically, this cleaning activity would mean that the headline profit numbers will be surprisingly lower. But if one were to read deeper into the analysis and take a call on what the likely earnings are going to be ahead, it will be better.
Sharp slide that we've seen today. Now there is one view that says that you need to kind of be a little guarded. How do you suggest we should look at the markets right now? Is this the time to take profits off the table, wait on the sidelines with cash to ride out the short to near-term volatility before re-entering, or do you think it makes more sense to stay put?
So the volatility that having fallen down to the lowest level right now in the past few months, I would say that suggests that the volatility may not necessarily go further down. So there is an upside risk to the VIX, which could mean the reverse as far as the Nifty is concerned. And like I've already outlined, the earnings season is going to have a lot of negative surprises simply because companies will start cleaning up their balance sheets. So therefore, it makes sense that given the index is at a high, one should rejuggle their portfolio such that they have adequate or enough cash available to quickly move to an upcoming uptrend. That uptrend may not necessarily have come in the month of April, may not even come in the month of May, but once we have the first showers coming in, that confirms the monsoon prediction, probably we'll have better days ahead for the market.
All right. Thanks, Mahantesh, for joining us with your perspective on the sharp slide that we've seen in the VIX. For the most part, you seem to suggest that this is a good sign for the markets, especially if you're going to ride out any kind of near-term volatility, and we'll see exactly what happens. But
if you like this video, then like, share and subscribe to ET Now.